What's up, everybody? Nate here. And one of the largest property owners and real estate developers in China, Evergrande, just filed for bankruptcy. Now, normally one company filing for bankruptcy doesn't really mean much for the general economy, but as we have seen, like here in the United States, when it comes to these really large property developers and landowners, if one seems to go under, then it can have a rippling effect throughout an entire economy. And that is the fear right now with China's Evergrande. China's Evergrande filing for bankruptcy could ultimately create a domino effect throughout the entire Chinese economy, creating a full-blown crisis. And if that were to happen, it could end up affecting us here at home as well. So today I want to talk about what exactly is going on with Evergrande and China's economy and what you need to know as a consumer and investor. China right now is going through its own property and mortgage crisis, pretty much spearheaded by one of its largest property developers, Evergrande. Now, this Evergrande issue didn't just come up overnight. It's actually been going on for a couple years now. You see, Evergrande is one of the largest property developers in the country, which means it owns a ton of land, and that means it also has a ton of debt, over $30 billion just in its offshore account. That means it has a lot of money floating around the economy, and it means that it keeps a lot of people employed, and it means that a lot of people have mortgages tied to Evergrande. So with it going into bankruptcy, that essentially means that all of those properties are now going to be subject to some sort of asset sale, and they could go on sale, which means prices could significantly drop, essentially tanking the market. China has a very interesting mortgage market that is very different from here in the United States. So when you actually get a mortgage here in the US, well, you are getting a mortgage to buy a house, and you can pretty much move in immediately to that house. But in China, it's a little bit different because their population is a lot higher, and there's a lot more demand for housing because incomes have been spiking as China's economy has been growing over the last few decades. Well, that has meant that people are buying into mortgages, but they don't actually have homes yet. So basically, you can get a mortgage in China without actually moving into the home. You can get a mortgage without your home even completely being built yet. So this means that millions of Chinese citizens are essentially paying into a mortgage that they don't even have a house yet. So that is problem number one. And the other big problem is that these big real estate developers are just continuing to buy more and more plots of land, considering more and more people are buying into mortgages. All of that money that people are putting towards their mortgage, well, these real estate developers and property owners are then taking those funds and essentially buying up more plots of land so they can continue to sell. And when business is good and they have the liquidity in order to purchase more properties and create and rebuild a lot of their existing ones, well, that means they're able to do a lot more, a lot faster. But because they're kind of running into debt issues and they don't have the cash to use right now, well, that means that they're essentially going under. So now they can't pay their $30 billion plus in debt, and that means that all of the real estate developers who are working on those properties, well, they're not going to be able to get paid either. So there's going to be a lot of job loss here. And then you also have people who purchased mortgages who are looking to get into a house and have been paying. Well, they might not get a house now because the real estate developer isn't going to be able to finish that property. Not to mention, you could see a full-on rippling effect throughout the entire economy because now people don't have a big trust of the mortgage system and the housing market in China, so they simply just don't want to pay their mortgage. That is exactly what happened a couple years ago. Millions of Chinese citizens essentially said they are not going to pay their mortgage at all, and that's what sparked Evergrande's first problems in the first place. They didn't have enough liquidity to move forward because millions of people said they are no longer going to pay their mortgage, so no money was going in, so nothing could essentially come out. Not to mention, not just in China, but throughout the rest of the world, we have a home unaffordability problem. I mean, just here in the United States, the median price of a home is around $300,000 to $400,000 to maybe even $500,000 in some areas. And the average 30-year fixed mortgage rate is well over 7.5% right now. And the same situation is going on in China. So it is really difficult for people to get homes in general. So not only do people in China not trust the mortgage system, they don't want to pay their mortgage, and no new people want to get a mortgage either. But that's not the only problem here. China also has another big economic issue, and that is with deflation. Now, pretty much every country around the world has faced something called inflation. This is when a monetary supply from a country is essentially inflated by printing a lot of money very quickly. What that does is bring down the buying power of each dollar in circulation. So you need more dollars in order to buy the same amount of things. But China actually has negative inflation called deflation right now. Basically, with all their economic lockdowns and inflation and prices going up so quickly, especially in the real estate market, well, nobody spent any any money for an extended period of time. So now the value of those dollars in China is actually getting a whole lot stronger. The value of money is going up, which you'd think would actually be a really strong thing, but what it can lead to is a complete deterioration of your currency. Basically, in a deflationary economy, prices start to go down, which means the buying power of your dollars is going up, but it also leads to lower spending. Lower spending isn't good for an economy in general, especially an economy like China's, because you have people who have a lot of expensive things like housing. So if there's not as much money going into the economy, then how are the workers going to get paid, and how are they going to continue to go out and stimulate the economy? Well, this has become a very serious issue in China, so much so that regulators are actually starting to talk about slashing interest rates. The Chinese central government actually just cut its one-year benchmark interest rate by a whole basis point, so 1 full percentage point. The 5-year ended up staying at exactly the same, but what this means is that they're making it a lot easier now for people to go out and spend money and get loans. We've seen here in the United States, what exactly does that do? Well, when the Federal Reserve actually dropped its benchmark interest rates to around 0% from like 2020 to around 2022, that meant that there was a lot of spending that happened all at once, which led to a lot of inflation and a lot of money printing. Basically, what you need to know here is that it kind of stimulates a lot of demand. So that is exactly what China is trying to do right now, stimulate a lot of demand and get people to start spending again. But that also leads to a lot of inflation and a deterioration of that country's currency. Now, one of the other major things that's going on in the Chinese economy right now is unemployment, specifically unemployment with the younger generation. Because a lot of the economic lockdowns actually blocked people from getting jobs and going out and doing the things that they wanted to do, well, that has meant that many young people are now kind of seeing the writing on the wall and they're leaving China. That means that the country is losing a lot of that economic output. Now, what exactly does this mean? China and pretty much every country around the world has a system where people who are around 18 to maybe 35 years old, they're going to be the highest producers in your economy, meaning they have the most output. These are your best working years. These are the years that you're going to make the most amount of money. But with people this age range actually leaving China, it means that you're leaving a lot of economic opportunity on the table. And people who are older than 35, say in their retirement years, well, now they can't benefit from the younger generation starting to work anymore. That's a big issue because even though China is starting to stimulate the economy by slashing its interest rates, well, there's just not enough demand out there for people to actually start working. Even though this younger generation is leaving China, there is still a huge population of young people that just aren't working in China at all, meaning that there's a lot of jobs out there that people just don't want to have, which is going to completely shift China's entire economy. Another thing too is that a lot of younger people are sort of protesting a lot of the Chinese government's regulations here. Like just a couple years ago, China actually banned the use of cryptocurrencies, and a lot of people in the country wanted to use cryptocurrencies because it sort of subverted every other country's currency, right? It's a third party. It's something that is controlled by the people for the people. So people wanted to use cryptocurrency as a medium of exchange that wasn't connected to their government and a lot of that government's practices. But China basically put an end to that, and that affected a lot of younger people, especially people who were making money inside the country with crypto. And then we have a major loss in manufacturing in China. Now, China has basically been the manufacturing capital of the world for basically the last 20 and 30 years, right? But over the last year or two, it's been losing out on a ton of jobs in this sector. Because of all of the regulations and economic lockdowns, well, companies here in the United States and basically all throughout the world that have manufacturing in China, well, they don't want to do business in the country because China is basically slowing everything down. We have this big demand here in the United States, but if China keeps locking everything down, well, that's costing companies a whole lot of money. So what are companies doing? Well, they're actually starting to move a lot of that manufacturing back here in the United States. Now, here in the United States, the first thing you need to understand about that is, yes, that means there's going to be a lot more jobs for individuals, but it also means that inflation could end up going up because now you have to pay people a lot more to work in the United States, which means you have higher incomes, which means you have higher spending. At first, that sounds like a really good thing, but at the end of the day, it means that prices are going to spike at some point because a lot of those jobs are now being done here in the United States again. But back in China, it means that China is losing out on on a lot of economic opportunity. Now, I will say the country is trying to pull back some of its regulations, especially when it comes to its zero virus policy, but it might be too little too late, as a lot of companies like Apple and Nike, well, they are moving their manufacturing into neighboring countries like Korea, Vietnam, and Taiwan. Basically, what you need to understand here is that companies want to save money when it comes to their manufacturing and their business. Now, for a very long time, China was the way to do that, and it was economically beneficial for China and its citizens and the United States and our citizens. But now it just doesn't really make any sense, as it's costing companies a lot more just to do business in China. Sure, they're going to pay a premium at first in the United States, but that is a short-term loss for a long-term gain, and they can almost guarantee that they're not going to be facing the same economic lockdowns and problems that China is facing here in the United States. So they would rather have the guarantee that business is going to be steady than to potentially save money working in China and have a lot of loss that could potentially come up because of lockdowns. All of this, and I mean all of this, at the end of the day affects China's bottom line, and that is spending, because with manufacturing jobs leaving China, being a higher unemployment rate, and people not able to afford homes and not going out and buying homes, well, that means there's a lot less wealth and a lot less spending going on in the country. Not to mention, they have a deflation problem, which means that people are more likely to save money right now than spend it, because their dollar is actually going up in value. That means there's a lot less money going into the economy, and there's a lot less money kind of floating around for taxes and for China to spend in general. China has a lot of countries that it does business with, namely the United States. And the United States borrows a ton of money from China, but if China doesn't have the same amount of money anymore, then the United States government isn't going to be able to borrow as much. If the United States government can't borrow as much money from countries like China, well, then how is it going to make its budget? Well, it only has two avenues. It can raise taxes or it can print money. Now, nobody likes their taxes being raised, and nobody likes to see a ton of money being printed all at once, because that leads to inflation. Ultimately, that could lead to harsher economic policies from the Federal Reserve here in the United States, because if inflation stays high and the Federal Reserve needs to continue to print money and we continue to have more tax dollars come out of our system, that could mean a more restrictive economy for longer. And Federal Reserve interest rates have already been very, very high and have already hit businesses hard in 2023. So if that was to continue for the long term because of these global economic problems, well, that could mean a lot less jobs and a lot less innovation and just a lot less spending and confidence here in the US too. At the end of the day, as an investor and a consumer, you cannot control anything that's going on in the global economy, let alone your local economy. But that doesn't mean that you shouldn't be smart with your money and take the time now to learn how money works and to learn how to gain more money and to see opportunities in the economy of today. That is exactly what I talk about on this channel 7 days a week. So if you haven't subscribed yet, be sure to do that before you go. I don't have a crystal ball in front of me and I can't tell you exactly what's going to happen with China, but all I can say is this: the United States ran into a similar property and mortgage crisis and an unemployment problem here in the United States around 2007 and 2008, and that led to the Great Recession and housing market crash. We don't really know if and when that bubble is going to pop in China, but the only thing that you can do as an investor and consumer is prepare yourself accordingly. Whether it pops or doesn't, you can see the opportunities and you're able to capitalize on them because you understand your money and you're prepared. And if you're ready to learn more and want to stay up to date with everything that's going on in the business and financial world, I've got another video ready for you right there, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.